I want you to picture a quiet suburban street, tree-lined, modest homes, lawns trimmed on Sunday mornings. For decades, this was the physical expression of the American dream. Now imagine something else standing at the front door. Not a family, not a young couple stretching their savings, but a balance sheet. This week, President Donald Trump said something that cut straight into the heart of that tension. He backed a plan to ban large institutional investors from buying single-family homes. His words were blunt, almost moral. People live in homes, not corporations. That sentence matters because it reframes housing not as an asset class, but as a social contract. Supporters see a line finally being drawn. Critics see symbolism without substance. Markets reacted instantly. Wall Street noticed. If this feels sudden, it isn't. This moment has been building for years. And to understand why this idea resonates so deeply now, we have to step back and ask how homes quietly became financial instruments in the first place. If you want to understand that shift, stay with me. At its core, this debate is not really about Donald Trump. It is about a single, unsettling question: who is housing for? For most Americans, a home is the largest purchase they will ever make. It is where wealth is built slowly, across generations. But over the last 15 years, housing has also become something else, entirely a financial product optimized for yield, scale, and return. When Trump talks about banning institutional investors, he is tapping into a growing sense that the system has drifted too far from its original purpose. That ordinary buyers are no longer competing with neighbors, but with capital pools measured in billions. The promise is simple: fewer corporate buyers means more homes for people. But the reality is more complex, because prices are not set by morality, they are set by mechanisms: supply, demand, credit, incentives. To understand whether this proposal changes anything at all, we need to understand how we got here and why Wall Street entered the front yard of the American home. That story begins not with politics, but with crisis. The turning point came in 2008. A financial collapse that began with housing ended by reshaping it. When the mortgage market imploded, millions of American families lost their homes. Foreclosures flooded the market, prices collapsed, entire neighborhoods were suddenly for sale, cheap, distressed, and unloved. For Wall Street, this was not tragedy, it was opportunity. Large investment firms stepped in with cash, speed, and scale. They bought tens of thousands of single-family homes in bulk, something individual families simply could not do. What had once been owner-occupied housing quietly became rental inventory. This was not accidental, it was structural. Low interest rates made borrowing cheap, technology made property management scalable, and policymakers, focused on stabilizing markets, welcomed any buyer willing to absorb excess supply. Over time, a new model took hold. Homes were no longer just places to live. They were income streams. By the time prices recovered, ownership patterns had already changed. And that shift set the stage for the tension we see today between a market that rewards capital and a society that depends on shelter. That tension is about to surface violently. Then came the first visible rupture. As Wall Street's presence in housing expanded, the consequences became harder to ignore. Rents began to rise faster than wages in certain markets. First-time buyers found themselves consistently outbid, not by neighbors, but by algorithms. Lawmakers noticed. So did communities. Cities where institutional ownership concentrated started to feel different. More uniform leases, less flexibility, a growing sense that decisions about local housing were being made far away, in boardrooms, not neighborhoods. This was the moment housing stopped feeling personal. Public pressure built quietly, year after year. Hearings were held, reports were written, but little changed. Previous efforts to limit institutional buying stalled in Congress, blocked by politics and industry resistance, until now. Trump's statement did not emerge in a vacuum. It landed on top of years of frustration and rising economic anxiety. That is why markets reacted immediately, and why this proposal feels explosive even before a single law is written. If you're trying to understand why this idea refuses to go away, it's because it touches something fundamental. And next, we need to look at the system beneath it all, the mechanics that turned homes into tradable assets. What sits beneath this debate is not ideology. It is design. Institutional investors did not invade housing by accident. They followed incentives embedded deep inside the system. Single-family homes offered something rare after 2008: stable cash flow, low volatility, and an asset tied to population growth. With enough scale, maintenance could be standardized, risk could be spread across cities, returns could be engineered. This is where the market quietly changed character. When large firms buy homes, they don't behave like families. They don't fall in love with a neighborhood. They optimize, they model, they price for yield. That matters because housing supply is slow and rigid. You cannot build new homes overnight. So when capital floods in faster than supply can respond, prices rise even if investors own a small share overall. The system rewards whoever can move fastest with the cheapest capital. That is not a young family. It is Wall Street. A ban, then, is not just a political gesture. It is an attempt to interrupt a mechanism. But interrupting a system always creates pressure elsewhere. And that pressure is about to surface again in ways few people are prepared for. Pressure always finds an outlet. As interest rates surged and affordability collapsed, a second crisis began to take shape, quieter, but no less destabilizing. Home prices remained high, monthly payments exploded, and yet supply stayed tight. Here is the paradox. Even as large institutional purchases slowed, homes did not become easier to buy because the system had already adapted. Smaller investors stepped in, mid-sized funds, local operators, individuals with access to credit. If large players are banned, many analysts warn they won't disappear, they'll fragment. This is why some economists are skeptical. If one category of buyer exits, another often replaces it. Not first-time buyers, but different investors. Markets seem to grasp this instantly. After Trump's comments, property-related stocks fell sharply. The reaction was not panic, it was recalibration. And then come the unanswered questions. What happens to the homes institutions already own? How do you define large? And what prevents capital from simply reorganizing itself under a new name? This is the danger of partial intervention. You strike one pressure point and the force moves elsewhere. Which brings us to the most important part of this story. Because while markets debate mechanics, real people are absorbing the consequences every single month. If you are watching this, housing is probably not an abstract debate to you. It is personal. It is the rent notice that arrives with another increase. The open house where the winning bid isn't even human. The feeling that no matter how hard you save, the finish line keeps moving. For younger Americans especially, the American dream now feels delayed or denied. You are told to be patient, to wait, to adjust expectations, but housing is not a luxury. It is the foundation everything else is built on. This is why Trump's message resonates beyond politics. Because when he says people live in homes, he's speaking to a lived experience. To the sense that the system has stopped working for those who play by the rules. Whether a ban works or not, the anger behind it is real. And it is growing. If this story reflects what you are feeling, you're not alone. Share it, talk about it, because housing policy only changes when pressure becomes impossible to ignore. But this is not just an American problem anymore. What is happening here is echoing far beyond US borders, shaping markets, politics, and power around the world. Look beyond the United States, and the pattern is unmistakable. Housing has become a global asset class. Capital moves across borders faster than people ever could. From London to Toronto, From Sydney to Berlin, homes are increasingly treated as stores of value, not places of life. America is not exporting policy. It is exporting precedent. If the US draws a hard line against institutional ownership, it sends a signal to global investors, to governments watching nervously, to markets that have assumed housing will always be open to financialization. But there is risk here. When one major market closes a door, capital does not disappear. It reroutes. Money flows to jurisdictions with fewer restrictions, weaker regulations, or higher yields. That can inflate bubbles elsewhere, destabilize currencies, and deepen inequality across borders. This is how local housing policy becomes geopolitics. Shelter turns into leverage, and affordability becomes a question of power. What Trump has proposed is not just a domestic fix. It is a stress test of the global housing system and of whether democracies can still control markets that operate at planetary scale. And once you see that, the real question shifts. It is no longer just, will this work? It becomes, what happens next? Because the future of housing now depends on which path we choose. And there are only three. From here, the future splits into three very different paths. The first is the optimistic scenario. A ban is narrowly defined, carefully enforced, and paired with serious supply expansion. Institutional buying slows. Local buyers face less competition at the margins. Housing doesn't become cheap, but it becomes reachable again. Not a revolution, a correction. The system bends without breaking. The second path is muddled. The ban passes, but loopholes multiply. Large players rebrand. Capital fragments. Mid-sized investors fill the gap. Prices barely move, but political leaders declare victory. Public frustration deepens because expectations were raised and not met. The mechanism survives largely intact. The third path is darker. Restrictions trigger capital flight. Investment drops without replacement supply. Maintenance declines, rentals tighten, affordability worsens in unexpected ways. What was meant to protect households destabilizes the market instead. These futures are not driven by intention. They are driven by design, by whether policymakers understand the system they are trying to fix. Housing sits at the intersection of economics, dignity, and power. Change it carelessly, and you shift all three, which is why the final question isn't about Trump. It's about us and whether we are ready to decide what homes are really for. This is not a story about banning investors. It is a story about drawing boundaries. For decades, we assumed markets would allocate housing efficiently, that if prices rose, supply would follow. But housing is not like stocks or bonds. You cannot trade it instantly, you cannot move it freely, and when it fails, the damage is social, not just financial. Trump's proposal forces a long-avoided conversation. Should homes primarily serve capital or citizens? That question will outlive this administration, this Congress, and this election. Whether the ban succeeds or fails, it has already done something important. It has exposed the architecture of a system many people only felt but never saw. If you want to understand where this debate goes next, how supply, politics, and power collide, stay with me. Subscribe. Share this with someone who feels locked out of the housing market, because the next chapter will not be written in boardrooms alone. It will be written in neighborhoods. And once those lines are crossed, there is no going back.